Have you ever wondered how some companies just consistently grow? Not just, getting bigger in terms of revenue, but really growing their influence. And they do it by mastering something that sounds fundamental, almost simple, like managing risk. Yet some organizations build absolute empires on it. Well, today we're pulling back the curtain on a true global insurance giant, Arthur J. Gallagher Co., or AJG. You might have seen that name in the financial headlines, especially after some pretty massive recent news. Our mission for this deep dive is to sift through all the data you've shared, the detailed financial reports, market analyses, investor presentations, basically, to cut through the noise and uncover the essential nuggets about AJG. We really want to get a handle on its business model, its really aggressive growth strategy that keeps analysts talking, and the fascinating, often complex market dynamics it operates within. Think of this as your shortcut to truly understanding what makes AJG tick.
Yeah, and what's genuinely fascinating here, I think, is that we're not just looking at a spreadsheet of numbers. We're exploring really a masterclass in how a company approaches growth in what many people would consider a pretty mature industry. It's a very delicate dance, isn't it? Balancing these huge monumental acquisitions with the fundamental metrics of creating real long-term value. And this raises a really important question, one we'll probably wrestle with throughout our conversation. Can a company truly buy its way to sustainable long-term value? Or does that organic strength, that internal growth, always win out in the end?
That's a perfect lens to view this through. So we're going on a journey today. We'll start with the basics, how AJG actually makes its money. Then we'll navigate the sprawling global industry it operates in, which is huge in itself. From there, we'll dive deep into its financial health, unravel its ambitious and frankly relentless growth strategy, which, let's be honest, is the real heart of their story right now. And finally, we'll tie it all together. What does all this mean for its future, its trajectory, and crucially for investors, its valuation in the market? So yeah, let's peel back those layers. Okay, let's unpack this then. Arthur J. Gallagher Co., founded way back in 1927, based out in Rolling Meadows, Illinois. They aren't just selling insurance policies like your local agent, right? So for you, the listener, trying to grasp this, what exactly is their core role in this massive, often pretty complex insurance world?
Right. At its core, AJG is a global insurance brokerage, risk management, and consulting services firm. That sounds like a mouthful, I know. But the crucial distinction, and it's really important, is that they act as an intermediary. Think of them as expert navigators, maybe facilitators, in a very intricate landscape. They plan and administer property and casualty PC and human resource risk management programs for a whole range of clients. But critically, they do all this without actually taking on the underwriting risk themselves.
Okay, so they don't hold the bag if something goes wrong.
Exactly. They don't hold the risk on their balance sheet like an insurance carrier, say Allstate or Chubb, would. Instead, they connect clients who need insurance with the carriers who provide it. And while doing that, they offer deep, specialized advice, they negotiate the best terms, and they manage the whole process for their clients. It's really about expertise and access, not about bearing the actual insurance risk.
So they're the guides, not the underwriters paying the claims. That makes sense. And you mentioned this dual segment structure earlier. How does that break down? And why is that particular way of organizing themselves so important for understanding their finances and their overall strategy?
Yeah, that dual engine structure is absolutely fundamental to understanding AJG. It gives them considerable scale, but also really important diversified revenue streams. It's cleanly split into two core segments, and they're highly complementary. The first, and by far the largest, is their brokerage segment. This is the dominant force, the main revenue engine. It accounts for approximately 88% of their total adjusted revenue, so the vast majority.
88%, wow.
Yeah. And its primary function, as we just discussed, is acting on behalf of clients, advising them on risks, negotiating with carriers, and then placing the insurance coverage. They're essentially the client's advocate in the insurance marketplace.
And what kind of specific services fall under that brokerage umbrella? Because insurance coverage can mean a whole lot of different things.
Exactly. It's broad. The brokerage segment offers a really comprehensive suite of solutions. This includes retail PC, insurance property, and casualty, which is what most people think of, commercial property, liability, workers' comp. But it also includes employee benefits, consulting, helping companies manage their health plans, retirement programs, things like that. Then there's wholesale brokerage. This is interesting. It's where they actually help other retail brokers place specialized or really hard-to-find risks. And they even do reinsurance, which is basically insurance for insurance companies.
Okay, quite a range. And who are they selling these services to?
Their client base is incredibly broad. They primarily focus on middle market commercial clients, think mid-sized businesses. That's a huge, huge segment. But they also serve small businesses, very large risk management accounts, the big corporations, and even individuals with complex insurance needs. Now, the revenue model here is predominantly commission-based. That makes up about 76% of the segment's commission and fee revenue.
Right, so tied to premiums.
Exactly. A significant chunk of their income is directly linked to the prevailing premium rates in the broader insurance market. That makes the segment quite sensitive to those market cycles we talked about, the hard and soft markets.
Yep.
We'll definitely dig into that more. The remaining 24% comes from fees they charge for specific value-added services, like consulting.
That paints a very clear picture of the brokerage side, the big engine. But you called it a dual engine. How does the risk management segment fit in? What role does it play, especially in maybe stabilizing things, given that cyclicality you just mentioned?
That's exactly its role. The risk management segment, which operates under the well-known brand Gallagher Bassett, is the crucial stabilizer. It contributes the remaining 12% or so of adjusted revenue, so much smaller than brokerage, but strategically vital. Gallagher Bassett is actually one of the world's largest PC third-party administrators, TPAs.
TPA, what does that involve exactly?
So what they do is provide services like adjusting claims on behalf of companies or insurance carriers after an incident occurs. They also help those organizations mitigate losses before they happen, offering loss control services and safety programs. Their expertise is really deep, covering areas like workers' compensation claims, general liability, auto liability claims, managed care programs to control medical costs, and property claims. Essentially, they help clients manage the claims process efficiently and effectively, and ideally reduce the number and cost of claims over time.
And who are the typical clients for these TPA services? Is it just the same companies AJG brokers insurance for, like cross-selling?
Not necessarily, and that's a really key differentiator for Gallagher Bassett, showing its strength. They primarily serve large, sophisticated clients, including many Fortune 1000 companies. But what's particularly noteworthy, and it really highlights their competitive strength in the TPA market, is that approximately 94%, a huge majority of their 2024 revenue in this segment, came from clients of non-affiliated brokerage customers.
So they're winning that business on their own merit, not just because they're part of Gallagher.
Precisely. It's not just internal cross-selling. It shows they can compete and win business against other major TPAs in the open market. And crucially, its revenue model is almost entirely fee-based. They charge fees for the services they provide, regardless of insurance premium levels. This provides a much more stable and predictable income stream compared to the brokerage segment. It makes it far less susceptible to that volatility of insurance premium cycles. So yes, it offers that valuable, powerful counterbalance, smoothing out AJG's overall financial performance across the cycles.
Okay, that dual structure makes a lot of sense now. Brokerage for growth, risk management for stability. Now, they're called a global firm. You hear that a lot. They mention operations in about 130 countries. That certainly sounds global. But where does the money actually come from? Do they really have significant operations everywhere, or is there a concentration we should know about?
It's a great question, because the label global can mean different things. They absolutely do have a significant global presence. They have their own owned operations in many key international markets, plus this extensive network of correspondent brokers. They call it the Gallagher Global Network, or GGN. That network spans approximately 130 countries, and it's crucial because it allows them to provide that essential local expertise for multinational clients operating across all sorts of different regulatory and cultural landscapes. That's a huge competitive advantage.
But the revenue?
Right. The revenue itself leans heavily towards developed markets, especially the United States. Before their massive, transformative Assured Partners acquisition, which we'll definitely get into, their revenue mix was roughly 64% domestic U.S. and 36% international. Post-acquisition, that balance shifts even further towards the U.S. On a pro forma basis, it's looking more like 70% U.S. and 30% international.
So even more U.S.-centric after the big deal.
Yeah. This concentration definitely enhances their scale and market share within the absolutely crucial U.S. market, no doubt about it. But the flip side is it also increases their sensitivity to specifically U.S. economic conditions, any shifts in U.S. regulatory policy, and evolving legal trends here. So yes, they are global in reach and capability, but their financial engine has a very strong domestic heart.
Interesting. Okay, you often hear about sticky customer relationships in certain industries. Is that really true for insurance brokers? I mean, wouldn't clients be tempted to shop around for better rates or service? And if the relationships are sticky, why does that matter so much for a company like AJG?
Absolutely, it's very true. And that stickiness is a critical component of AJG's incredibly durable business model. You could almost call it a hidden moat. First, just think about the fundamental nature of insurance for most businesses. It's a non-discretionary expense,
Yeah,
right?
you have to have it.
You simply have to have it to operate legally and safely. It's not like buying, I don't know, new office furniture or a luxury service that you can just cut back on during lean times. On top of that, you have the inherent complexity of risk management, especially for mid-sized and larger businesses. Combine that complexity with the established, often long-standing relationships between clients and their trusted brokers. Well, it creates significant switching costs.
It's a pain to move, basically.
It's a huge pain. Moving your entire commercial insurance portfolio with all its specific nuances, coverage needs, historical claims data, moving all that from one broker to another is not a simple task. It takes considerable time, effort, and it involves transferring deep institutional knowledge about a client's specific risk profile. Brokers really get embedded in their clients' operations, and this dynamic results in very high client retention rates. Management consistently highlights this as a core strength. They even specifically note fantastic client retention over in the risk management segment, Gallagher Bassett, where the relationship is often even deeper because they're handling sensitive claims data and loss mitigation efforts day in, day out.
So it's not just about finding the cheapest price.
Not at all, especially in the commercial space. This stickiness isn't just a nice to have, it creates a remarkably stable revenue foundation. It's largely insulated from the kind of discretionary spending cycles you see plague so many other industries. And when you layer that onto the interplay we discussed, the stable fee-based risk management segment combined with these high retention brokerage clients, it acts as a really powerful buffer against broader economic cyclicality. All of this leads to more predictable earnings and, crucially, consistent cash flow generation, which, as you know, is incredibly valuable to investors, especially in a volatile world.
Right. That predictable cash flow is key. So that strong, reliable revenue base gives them a solid foundation to build on. Let's zoom out a bit now. This global insurance brokerage market they operate in. It's just massive, isn't it? What kind of growth are we talking about globally, and what are the big forces driving it?
It is indeed a colossal industry, yeah. And importantly, it's experiencing robust structural growth, not just cyclical ups and downs. The global insurance brokerage market size. Estimates put it at over $314 billion in 2024. But looking ahead, it gets really interesting. Market research firms, like Precedence Research, for instance, project it to reach nearly $758 billion by 2034.
Wow, more than double.
Yeah, that reflects a staggering compound annual growth rate, or CAGR, of around 9.2%. Other estimates, like Mortar Intelligence, are in a similar ballpark, projecting maybe 9.47% through 2030. So whichever way you slice it, we're talking about substantial, sustained growth for the foreseeable future. That makes it a very attractive sector to be a leader in.
And what's fueling that kind of high single-digit, maybe even low double-digit growth consistently? It sounds like more than just basic economic expansion.
Right.
Absolutely. It's driven by several powerful long-term secular tailwinds that are fundamentally reshaping the global risk landscape. First, there's the sheer increasing complexity of the risks that businesses and individuals face today. We're seeing a proliferation of threats that either didn't exist or weren't nearly as prominent a decade or two ago. Think sophisticated cybersecurity attacks, right?
Yeah, definitely.
Or the increasing frequency and severity of climate-related events, wildfires, floods, hurricanes, and incredibly intricate global supply chains that introduce all sorts of new potential points of failure and vulnerability. All of these complex, evolving risks drive a much greater demand for sophisticated risk advice and the specialized brokerage services that firms like AJG provide. Companies need expert guidance to navigate this.
So more complexity means more need for brokers.
Exactly. Second, digitalization is playing a significant role. The adoption of digital platforms, innovative insurtech solutions. It's not just about making insurance processes more efficient internally for the brokers and carriers. It's also expanding the reach of brokers, making insurance products more accessible to new customer segments, and allowing for more tailored, data-driven solutions. And finally, just fundamental global economic development is a factor. Especially in emerging markets, you have rising incomes, increasing asset values. People and businesses simply have more wealth and property to protect. That naturally boosts the demand for insurance products. So this structurally growing market provides a very favorable backdrop for a company like AJG to continue its expansion both organically and through M&A.
It really sounds like an almost irresistible growth story, that market backdrop.
Yeah.
But as you mentioned, the insurance market itself has its own well-known ups and downs, right? That cyclicality. What exactly are hard and soft markets? You hear those terms thrown around a lot. And how do they directly impact a broker like AJG?
That's a crucial point because, yes, while the underlying demand for brokerage services is growing structurally, the property and casualty P&C insurance industry itself is characterized by this well-established cycle of hard and soft market conditions. And these cycles directly influence broker revenues, especially in that big brokerage segment, because commissions are often tied to premium levels. So, a hard market. That's when you see rising premium rates, often quite sharply. This is usually accompanied by stricter underwriting standards. Insurers become much pickier about who and what they'll insure, and reduced insurance capacity as carriers become more cautious, maybe due to recent losses or lower investment returns. In this environment, broker commissions and fees naturally tend to increase because the underlying cost of the insurance policies themselves is going up. Brokers also arguably provide more value, finding scarce capacity for clients.
Okay, so hard market, rising prices, good for commissions. What about a soft market?
A soft market is the opposite. It's characterized by stable or even declining premium rates. You see broader coverage terms being offered, and there's ample capacity as insurers compete aggressively for business, often after a period where they've been quite profitable and want to grow market share. This environment can exert downward pressure on broker revenue growth simply because the commissions are tied to those lower or stagnant premiums. Growth has to come more from winning new business or selling more services.
So where are we in that cycle right now? Is it hard, soft, or is it more complicated than that?
Currently, it's actually a truly bifurcated market, meaning it's a mix. It's quite complex right now, and that adds a layer of challenge. According to market intelligence, for instance, from Marsh's Global Insurance Market Index, property insurance rates have actually been softening globally. They saw about a 7% decline in the second quarter of 2025.
Softening. Why?
It seems to be driven by increased competition among carriers, maybe some new capital coming into the market looking for returns, especially after a period of very hard property rates previously. However, at the same time, casualty lines, think general liability, auto liability, workers' compensation, they remain firmly in a hard market. Rates there increased about 8% in Q2 2025.
Okay, so property down, casualty up. What's driving the casualty hardness?
That's largely due to ongoing deep concerns about claim severity, meaning the cost of individual claims is rising rapidly. There's also what the industry calls social inflation. That's the rising cost of insurance claims beyond general economic inflation, often attributed to changing societal attitudes towards corporate liability, a more litigious environment in places like the U.S., and shifts in jury behavior. And related to that, those increasingly large, sometimes astronomical, nuclear jury awards we keep reading about, especially in U.S. liability cases. Awards that just blow past historical norms.
Right. So this mixed bifurcated environment, what does it mean for AJG?
It presents both tailwinds, primarily from the hard casualty side, boosting commissions there, and headwinds from the softening property market, potentially dragging on commissions in that line. It means their ability to deliver consistent organic growth becomes even more critical as an indicator of their underlying operational strength. It shows whether they're successfully winning new clients, expanding existing relationships, cross-selling effectively. Rather than just riding a wave of generally rising premium rates across the board, their execution really matters in this environment.
That's a fascinating dynamic, that split market. It sounds like they need to be incredibly nimble. Now, thinking about the competitive landscape, is this brokerage market dominated by just a few behemoths like maybe Marsh and Aon? Or is it more of a free-for-all for anyone who wants to hang up a shingle?
Right.
What really stops new players from just jumping in and seriously competing with the likes of AJG?
It's an interesting structure, almost paradoxical in a way. At the lower end, it is incredibly fragmented. Highly fragmented. In the U.S. alone, estimates suggest there are over 18,000 independent agents and brokers. So for small, local players, yes, it can feel a bit like a free-for-all to some extent. Barriers to entry for a small shop are relatively low. However, at the top end, it is highly consolidated. Among the top 100 U.S. brokers, for example, the top 10 firms account for a commanding 70% of the total revenue generated by that group.
70% for the top 10. Okay, that's concentration.
Exactly. It underscores the dominance of the large-scaled players, and it highlights a critical point. While starting a small local brokerage might be relatively easy, competing effectively at the national or global level where AJG plays, that requires significant scale-based advantages. These advantages effectively form a protective moat around the established giants, making it very difficult for newcomers to challenge them directly for larger, more complex clients.
Okay, so what are those moat advantages? What specifically makes it so hard for a new entrant to challenge the big guys like AJG, MMC, or Aon?
They're multifaceted, really. First, and perhaps most obviously, is global reach and a vast network. The ability to service multinational clients seamlessly across dozens, even hundreds of different countries with varying regulations and languages, that's something small players simply cannot replicate. Second is niche expertise. Deep intellectual capital and specialized teams focused on highly complex industries, think aviation, marine, energy, construction, or specific risk lines like cyber liability, political risk, or product recall. That depth of knowledge is hard-won. Third, strong carrier relationships are absolutely vital. These brokers have long-standing, high-volume relationships with a wide range of insurance carriers globally. This gives them access to underwriting capacity, often preferential terms, and sometimes even proprietary insurance products for their clients. That's a huge competitive edge. And fourth, increasingly critical, is data and analytics. Leveraging vast data sets built up over years to provide sophisticated risk modeling, benchmarking against peers, and actionable insights that help clients make better risk management and insurance purchasing decisions. That requires massive investment in technology and talent.
So scale really begets more advantages.
It really does. And this industry structure, fragmented at the bottom, consolidated at the top, with significant scale advantages, is actually the primary catalyst for AJG's M&A-driven strategy. The sheer number of small, independent firms creates this continuous, deep pipeline of potential acquisition targets. And the clear advantages of scale incentivize consolidating those smaller firms onto a larger, more efficient platform like Gallagher's. M&A isn't just an option for growth in this industry. For players wanting to compete at the highest level, it's almost a strategic imperative.
Okay, that makes perfect sense why M&A is so central.
Yep.
So given that intensely competitive yet consolidating landscape, where does AJG actually stand today against the biggest names? You mentioned Marsh & McLennan, MMC, AN. Yeah. How do they stack up?
AJG has firmly cemented itself in that top tier, absolutely. And interestingly, they've actually been climbing the ranks. Based on the latest revenue data from 2023, industry analysis, for example, by AM Best, ranked AJG as the world's third largest broker. They actually surpassed Willis Towers Watson, or WTW, to claim that number 3 spot. So they're now positioned right behind Marsh & McLennan, MMC at number 1, and Aon Plf AON at number 2.
Third largest globally. That's impressive. How are they doing in terms of performance, like growth, compared to those bigger powers?
Their organic growth performance, which again is crucial because it shows how well their existing business is performing, excluding the impact of acquisitions, has been highly competitive, often outpacing their larger peers. For instance, in the second quarter of 2024, their combined brokerage and risk management segments posted organic growth of 7.7%. Now, this compared very favorably to MMC's 6% and WTW's 6% in that same period. They did lag Brown & Brown, BRO, another major competitor, which saw a strong 10% organic growth in Q2. But looking at the full year 2023, AJG's organic growth was near 10%, which was generally better than most of its large competitors over that full year. So this consistent ability to generate strong organic growth, even while executing such an aggressive acquisition strategy, really points to a healthy underlying business. They're effectively winning new business and expanding existing client relationships. It's not just an M&A machine. The core business is performing well.
Right. Okay, let's dive into that M&A machine then, because here's where it gets really interesting, as you've hinted. Their growth story isn't just about good organic performance. It's massively fueled by this relentless pace of acquisitions. Just how prolific are we talking here? And what's the strategy behind it all? Are they just buying anything, or is there a plan?
Oh, there's definitely a plan. You're absolutely right. M&A is truly the central pillar of AJG's growth strategy. It's not just something they do. They've systematically developed it into a core competency. It's almost like an assembly line with a highly refined, repeatable process for identifying, acquiring, and integrating businesses. The numbers are staggering. We're talking about over 582 acquisitions in their history. And get this, 195 of those have occurred in just the last 5 years alone.
Wow, almost 200 deals in 5 years.
Yeah, it's an incredible pace. Just in 2024, for example, they closed 48 mergers. Those deals collectively added an estimated $387 million in annualized revenue to their top line. Their strategic focus is broad but targeted. It ranges from smaller tuck-in brokerages. These help them achieve greater geographic density in key markets or add specific niche expertise, maybe in a particular industry, all the way up to a much larger, truly platform-altering acquisitions. They target firms across their main areas: retail P&C, wholesale brokerage, employee benefits consulting, and even managing general agents or MGAs, which are specialized underwriting agencies. The overarching goal, they always emphasize, is finding culturally compatible firms. They look for entrepreneurial companies that they believe will benefit from joining Gallagher's global platform, leveraging its superior resources, technology, market access, and critically fitting into their unique corporate culture, which they call the Gallagher way. It's about buying strategically important pieces that fit culturally and operationally, and then making them stronger and more efficient on their platform.
That's an incredible volume and a clear strategy.
Yeah.
But the biggest deal of all, the one that really moved the needle, got everyone talking, and changed their scale dramatically, was the Assured Partners acquisition.
Yeah.
What made this particular transaction so significant, and how does it fundamentally change the game for AJG going forward?
Yeah, the Assured Partners acquisition, it really represents a strategic inflection point for AJG. It's a game changer, no doubt about it. They announced the agreement to acquire Assured Partners for a gross consideration of $13.45 billion back in December 2024.
$13.5 billion. Huge number.
It is. It's the largest acquisition in AJG's history by a very wide margin, and it's actually one of the largest deals ever done in the entire U.S. insurance brokerage industry. This transaction fundamentally alters AJG's scale and competitive positioning in a way that very few deals ever could. Strategically, the rationale was clear. It significantly deepens AJG's presence in that crucial U.S. middle market segment for both PC and employee benefits, an area where Assured Partners was particularly strong and where AJG wanted more heft. It also dramatically enhances their capabilities in key industry niches where Assured Partners had built expertise, think transportation, energy, healthcare, public entity sectors. And simultaneously, it adds substantial scale to their existing operations in the UK and Ireland.
Yeah.
So in essence, the single deal accomplishes what might have taken AJG decades to build through its historical pace of smaller tuck-in acquisitions. It's a massive leap forward in scale and capability.
A truly monumental deal. What about the financial side of pulling off something that huge? How did they pay for it? And what are the immediate risks or challenges that come with trying to integrate something of that magnitude?
Financially, yeah, it was a heavy lift. It was funded through a significant combination of new equity issuance and substantial new debt. As you can imagine, this significantly increased the company's financial leverage, at least in the short term. We'll touch on that more. In terms of valuation, they paid a pro forma EBITDAC multiple of 14.3x. And just for clarity, EBITDAC is earnings before interest, taxes, depreciation, amortization, and certain change in control or contingent compensation adjustments. It's a common metric in this industry. Net of a deferred tax asset they acquired, the multiple was about 12.4x. The company expects the deal to be double-digit accretive to their adjusted earnings per share relatively quickly, and that includes significant anticipated cost and potentially revenue synergies.
Has the integration process started? Any hurdles so far?
Well, the execution hasn't been entirely smooth sailing right out of the gate. The deal's actual closing was pushed back several months, eventually happening in August 2025. This delay was due to an extended regulatory review by the Federal Trade Commission, the FTC, here in the U.S. They requested additional information as part of the standard Hart-Scott-Rodino antitrust review process.
Okay, regulatory scrutiny, not surprising for a deal that big.
Right. The delay itself highlights the deal's immense market significance. It really consolidates the market further. And of course, any delay introduces a prolonged period where integration risk looms. That includes things like the potential for employee attrition, especially at a company like Assured Partners, which was known for being highly decentralized. Integrating that successfully into Gallagher's more established culture and systems is a major undertaking. But the prize, if they get it right, is significant. This acquisition positions AJG to compete much more directly for those larger, more complex accounts that have historically been dominated by the top two players, Marsh & McLennan and Aon. The success or failure of the single massive integration will likely be a defining factor for AJG's performance and shareholder returns over the next 5 to 10 years. This isn't just another tuck-in, this is a company-altering bet.
It really underscores how central M&A is. But okay, M&A, especially that huge deal, is clearly a massive part of their growth story. But what about growth from their existing businesses? Are they still focused on that? How are they innovating and expanding organically without just buying companies? And how does technology fit into that picture?
That's a really important question because even with that massive M&A engine running full tilt, organic growth from existing clients, winning new clients not brought in via acquisition remains absolutely crucial for long-term health and validating their model. AJG drives this organic growth through several complementary initiatives that leverage their established platform and expertise. One key way is by leveraging their deep niche expertise in various industries. Delivering highly tailored risk solutions builds loyalty and fosters stronger client retention because they're providing specialized value that generic brokers can't match. They're also increasingly using advanced data and analytics. This isn't just about efficiency, it's about providing clients with better insights, benchmarking, more proactive risk management advice. They're trying to move beyond just placing policies to becoming true risk consultants, which is a stickier, higher value relationship.
Using data to be smarter advisors.
Exactly. Cross-selling is another important lever. Their global platform is designed to facilitate introducing risk management solutions, like Gallagher Bassett's TPA services, to their brokerage clients who might benefit, or offering international capabilities to domestic clients who are expanding overseas. Underpinning all of this, though, is a strategic focus on digital transformation and technology. They know they can't just rely on the old ways. They're not just buying companies, they're investing heavily in things like AI and data analytics for both internal operational efficiency and enhanced client service delivery. For instance, they're using AI-powered tools for talent assessment and leadership coaching within their consulting practice. That might sound a bit abstract, but think about it. Better talent assessment helps integrate acquired teams faster and smoother, impacting synergy realization. They even partnered with a firm called Sutherland for a zero-cost cloud migration project that reportedly reduced their cloud total cost of ownership by a remarkable 52%. These technology investments are critical, not just for saving money, but for creating a scalable, efficient, technologically advanced platform that can successfully absorb that high volume of acquisitions and maximize their value over the long run. Technology enables the M&A strategy to work at scale.
That's a comprehensive picture of the strategy M&A fueled, but with organic growth and tech enablement too. So let's look at the numbers. What does all this intense activity, the rapid M&A, the ongoing organic growth efforts, the tech investments actually look like on their financial statements? Bottom line, are they effectively making money and generating robust cash flow from all this effort?
Well, AJG has definitely delivered a very compelling top-line growth story, no question about it. If you look at reported revenues before accounting for certain reimbursements, they increased from $8.55 billion in 2022 to $10.07 billion in 2023. That's strong growth of 17.8%. That momentum continued into 2024, with revenues reaching $11.55 billion, another 14.7% increase year over year. And for the trailing 12 months ending Q2 2025, that revenue number hit an impressive $12.46 $7 billion. So consistently strong reported growth.
And what about the organic piece of that? How much is coming from the underlying business versus acquisitions?
Their organic growth, which strips out the impact of M&A and foreign exchange and really shows the health of the existing operations, was also robust for a while. It neared 10% in 2023, which is very strong. It finished 2024 at 7.0%. However, 2025 has shown some moderation. Organic growth was 9.0% in Q1, which is great, but then it slowed to 5.4% in Q2.
Like slowdown in Q2.
That likely reflects a couple of things. Partly, the softening property insurance market we discussed earlier, which puts pressure on commissions there, and partly just increasingly difficult comparisons to prior periods when growth was exceptionally high coming out of the pandemic and deep into the hard market. Management has guided for a full year 2025 organic growth rate in the range of 6.5% to 7.5%. Still healthy, but maybe not the near double digits seen recently. Acquisitions are, of course, still a significant contributor. Those 48 mergers in 2024 added that estimated $387 million in annualized revenue. And just for the first half of 2025, acquisition rollover revenues for the brokerage segment alone totaled about $203.8 million. So yes, revenue is growing strongly overall, but the organic component is showing some variability now, which is something to watch.
Okay, top line looks strong, maybe moderating slightly organically. What about profitability? Are margins holding up with all this growth and acquisition activity? Or is there a cost to this rapid expansion that's eating into profits?
Profitability, which they often measure using adjusted EBITDA margin again, earnings before interest, taxes, depreciation, amortization, and certain compensation adjustments, that has actually shown a consistent and pretty impressive upward trend over the last few years. The margin for the full year 2024 came in at 33.3%. That represents an impressive expansion of 640 basis points since 2019, so nearly 6.5 percentage points of margin improvement. That demonstrates real operating leverage.
640 basis points is significant expansion.
It really is. And this trend continued into the first half of 2025. Q1 margin reached a very strong 41.1%, and Q2 came in at 34.5%. Now, this margin expansion is driven by a combination of factors. There's operating leverage on that strong organic growth when revenue grows faster than costs. There are ongoing cost control initiatives, including their use of centralized centers of excellence for shared services, and of course, the realization of cost synergies from past acquisitions as they integrate them onto their platform.
It's a but coming.
Well, yes, there's an important caveat, especially for that recent Q2 2025 number. The reported margin in Q2 was artificially inflated, significantly so, by approximately 340 basis points.
Artificially.
It was due to a surge in interest income they earned on the substantial amount of cash they were holding on their balance sheet in advance of the Assured Partners acquisition finally closing. They raised the money early, parked it, and earned good interest on it while waiting. So while the underlying margin expansion from operations is still positive, it was much more modest in Q2 than that headline 34.5% number might suggest if you strip out that temporary interest income boost. It just reminds us to always look under the hood a bit.
Got it. Good clarification. Okay, so far, mostly positive. Strong revenue growth, expanding margins was a footnote for Q2. But what about their cash flow generation? And maybe more critically, their capital efficiency? Are they actually generating enough cold, hard cash from all this activity? And are their huge investments, especially in M&A, paying off effectively in terms of returns on the capital they're deploying?
This is where the narrative starts to get a bit more complex, maybe where we see some tension. And it's a really crucial point for investors thinking about long-term value creation. While the revenue and profit growth figures look good, some metrics that measure capital efficiency have actually weakened recently. And this directly reflects the balance sheet impact of their very capital-intensive growth strategy. For instance, looking at cash flow, net cash provided by operating activities for the first 6 months of 2025 was $445.7 million. That sounds like a lot, but it was a significant decrease from the $908.8 million generated in the first half of 2024.
Almost half. That's a big drop.
It's a noticeable drop, yeah. Needs context, but it's something to note. More fundamentally, though, are the return metrics. Both return on equity, ROE, and a return on invested capital, ROIC, have trended downward over the past couple of years. ROE, which measures profit relative to shareholders' equity, went from 12.57% in 2022 down to 9.49% in 2024. And ROIC, which is arguably the more critical metric for a company growing heavily through acquisition because it measures how efficiently they use all the capital invested in the business, both debt and equity, to generate profits, saw a similar pattern. It declined from 6.17% in 2022 to 5.51% in 2024.
Okay, ROIC down to around 5.5%. Is that good or bad? What's the benchmark?
Well, that's the rub. Some external analyses looking at recent data place AJG's ROIC even lower, around 5.44%. And critically, that figure is below its estimated weighted average cost of capital, or WACC, which is often calculated to be around 6.35%.
ROIC below WACC. That sounds not ideal.
It's definitely not ideal. It's a potential red flag for sure.
So let's connect this back to the bigger picture, maybe even to our opening question about buying growth versus organic strength. What does this compression in capital efficiency, particularly ROIC, potentially falling below the cost of capital, truly mean for the long-term investment thesis here?
It means, while this compression is a direct and a frankly logical consequence of their hyper-aggressive M&A strategy, it's the price they're paying, at least initially, for that rapid-scale growth. To fund those hundreds of acquisitions, and especially the monumental Assured Partners deal, AJG has had to issue substantial amounts of new debt and new equity. This significantly expands the invested capital and shareholders' equity figures. Those are the denominators in the ROIC and ROE calculations, right? So the base gets much bigger.
Right, the denominator grows faster than the numerator, at least for now.
Exactly. Their balance sheet has also expanded dramatically with huge amounts of goodwill and intangible assets stemming from these deals. These represent the premium paid over the book value of the acquired companies, and they are part of that invested capital base. So what this pattern implies is that AJG is currently in a very intense investment phase. They are deploying vast sums of capital through M&A. And the returns on all that newly deployed capital, The earnings and cash flow from the acquired businesses, they haven't yet fully materialized or haven't yet caught up to the increased cost of that capital, the WACC. For investors, this poses a significant challenge to the long-term investment thesis. The market is essentially giving them credit now for future returns, but ultimately those returns must eventually exceed their cost of capital for the strategy to be truly value-creating in an economic sense. If ROIC remains persistently below WACC over the long term, it would imply that despite the impressive revenue and profit growth, they might actually be destroying economic value with each new dollar invested through M&A. That's a scenario that is simply unsustainable in the long run and would put immense pressure on their premium stock valuation. The pressure is on to prove the M&A strategy generates true economic profit.
That really clarifies the tension. Growth is great, but it has to be profitable growth in terms of capital returns eventually. Now, you mentioned all those acquisitions, especially assured partners, had to be paid for somehow, involving debt. What's happening with their debt levels specifically? How leveraged are they, and how exposed does that leave them to changes in interest rates?
Yeah, to fuel this insatiable appetite for acquisitions, AJG has significantly increased its use of debt financing. It's a key part of their funding strategy. Total debt on their balance sheet rose sharply. It went from about $7.97 billion at the end of 2023 up to $13.16 billion by the end of 2024.
That's a big jump in 1 year.
A very big jump, yeah. And that was largely due to pre-funding the Assured Partners transaction, raising the debt before the deal actually closed. Consequently, their financial leverage has increased quite a bit. Their debt-to-EBITDA ratio, a common measure of leverage, stood at 3.87x at year-end 2024. Now, management is confident. They believe they can maintain a strong investment-grade credit rating, and they do have a historical track record of deleveraging the balance sheet fairly quickly after large acquisitions through strong cash flow generation. However, there's no denying that this elevated debt load definitely increases the company's financial sensitivity to interest rate changes. Higher rates mean higher borrowing costs, which directly eats into profitability and cash flow available for other priorities. And it means potential shortfalls in earnings or cash flow needed for debt service could become a more pressing concern if the economy were to weaken significantly. It's a calculated risk they're taking to achieve that transformative growth, but it is a risk nonetheless.
Okay, so they're betting heavily on M&A, funding it with significant debt, and facing pressure to prove the returns. Given all this, how does AJG actually decide where to put its money? What are their stated capital allocation priorities? And what does that tell us about their view of the future?
AJG employs a very clear, explicitly stated, and highly hierarchical capital allocation strategy. And it is undeniably growth-oriented first and foremost. Their absolute number one priority, without question, is mergers and acquisitions. Management explicitly views M&A as the highest return use of their capital. They see it as a strategic imperative for consolidating that fragmented brokerage market we discussed earlier, building scale, and enhancing capabilities. The company had projected, for example, approximately $3.5 billion of M&A capacity just for 2024, funded by a combination of their free cash flow and additional borrowings. And then, of course, the massive $13.45 billion Assured Partners deal completely underscores the depth of this commitment to acquisition-led growth. It dominates their capital plans.
So M&A is king. What comes next?
Their second priority is paying dividends to shareholders. They have a very proud history here, a consistent and growing dividend. They've increased it for 14 consecutive years now, with a robust 5-year compound annual growth rate, CAGR, of about 7.27%. But they maintain a relatively conservative payout ratio, typically around 24% of earnings. This ensures the sustainability of the dividend while still retaining the substantial majority of their earnings to plow back into that number one priority, M&A. And finally, their third priority is share repurchases. Buybacks are definitely opportunistic and tertiary in their framework. They're generally used when management perceives the stock is undervalued in the market, or sometimes strategically to offset the dilution caused by employee equity compensation programs. For example, they announced a $1.5 billion share repurchase program back in July 2021. So the hierarchy is crystal clear. M&A first, dividends second, buybacks third, and opportunistic.
And the success of that whole strategy really hinges on?
It hinges critically on two things. First, a continued supply of attractive acquisition targets coming onto the market at reasonable valuations. And second, maybe even more importantly now, given the scale, AJG's ongoing ability to successfully integrate these acquired companies efficiently, realize those projected synergies, and ultimately drive that ROIC metric convincingly above their WACC. That's the linchpin.
Okay. Let's talk about the people driving this. Who's at the helm of this massive, rapidly growing enterprise? Who's orchestrating this ambitious M&A strategy? And how is the company governed to ensure long-term stability and accountability, especially with such a dominant strategy?
AJG is actually quite unique for a large public company in its leadership structure. It is a very long-tenured, family-led management which provides a strong sense of continuity and fosters a very distinct corporate culture. J. Patrick Gallagher Jr. has been chairman and CEO since way back in 1995. He's the third-generation leader from the founding family.
Since 95, wow, that's a long tenure.
It really is. He's widely recognized as the primary architect of their modern, aggressive growth strategy through M&A, and also the champion of the distinct corporate culture they call the Gallagher Way, which emphasizes ethics, teamwork, and entrepreneurialism. His nearly three-decade tenure provides remarkable strategic consistency. The broader senior executive team also consists largely of long-serving veterans, including President Thomas J. Gallagher and COO Patrick M. Gallagher, both also members of the founding family. This ensures deep internal experience and a consistent strategic vision across the highest ranks.
Okay, family-led, long tenure. What about corporate governance, checks and balances?
Yeah.
Especially with the CEO also being the chairman.
That's a fair question. While Mr. Gallagher does hold both the chairman and CEO roles, a structure that sometimes raises governance concerns about concentrated power, the board has implemented what seems to be a fairly robust counterbalance. They have an empowered independent lead director, currently David Johnson. He plays a critical role, presiding over executive sessions where only independent directors meet, approving board meeting agendas and information flow, acting as a liaison between the board and the CEO. This provides a strong, independent oversight mechanism. The board itself is largely independent. All but two directors currently meet the formal independence criteria set by the NYSE, and the company states a commitment to ongoing board refreshment and increasing diversity. They also maintain fully independent audit, compensation, and nominating governance committees, which is standard best practice. Plus, importantly, given their business, they have a dedicated risk and compliance committee providing specific oversight for crucial areas like cybersecurity, data privacy, and regulatory compliance, all huge risks for them. And finally, management compensation appears strongly aligned with long-term shareholder interests. It's heavily weighted towards pay for performance. Annual cash bonuses are tied directly to achieving adjusted revenue and EBITDA growth targets. And long-term incentives are mostly granted as performance share units, PSUs, which typically vest based on achieving specific targets for 3-year adjusted EBITDA per share growth, plus some stock options. They also have robust stock ownership guidelines for executives requiring them to hold significant amounts of company stock. So incentives seem aligned with profitable growth.
Okay, it sounds like the governance structure is adapted. Now, no company, especially one this large, this global, this acquisitive, operates in a vacuum. What are some of the biggest challenges and headwinds AJG is facing right now? Beyond just the immense task of integrating assured partners, what else keeps them up at night?
Yeah, they certainly face a range of significant external and internal challenges that could impact their future performance. It's not all smooth sailing. Starting with the broader macroeconomic environment, you have inflation. Inflation actually has a mixed impact for brokers. On one hand, it can increase insured values like property values or replacement costs, and therefore premiums, which can be good for commission revenue. But on the other hand, it also increases operating costs, especially compensation costs. People are their biggest expense by far. So high inflation can potentially compress margins if they can't pass those costs through. Then there are interest rates, again, a double-edged sword. Higher rates obviously increase their borrowing costs, which is now particularly significant given the substantial increase in debt they took on for the Assured Partners acquisition. That directly hits the bottom line. However, higher rates can also boost the investment income they earn on the substantial fiduciary funds, premiums collected but not yet remitted to carriers, and operating cash they hold. We saw that clearly with the 340 basis point margin boost in Q2 2025, which came largely from higher interest income. So it's a complex interplay.
Okay, macro is mixed. What about their global footprint? You said it was an advantage, but it must create some regulatory headaches too, right? Operating in 130 countries sounds complicated.
Complicated is an understatement. That huge global presence translates directly into extremely complex regulatory and compliance risks. Operating in so many different jurisdictions subjects them to a dynamic, overlapping, and often opaque web of constantly evolving regulations. For instance, broker compensation practices, particularly the use of contingent commissions, paid by insurers based on volume or profitability of business placed, often face regulatory scrutiny around the world regarding potential conflicts of interest. This leads to increased disclosure requirements and potential pressure on those revenue streams. Data privacy and security are monumental concerns. They handle vast amounts of sensitive client and employee data. They must comply with a patchwork of stringent laws like GDPR in Europe, various state-level laws like the CCPA in California, and many others globally. A failure here, a data breach, could mean substantial fines, debilitating legal action, and severe reputational damage. And operating globally also exposes them to strict anti-corruption laws, like the U.S. Foreign Corrupt Practices Act, FCPA, and the UK Bribery Act, particularly in emerging markets. This demands rigorous internal controls and constant vigilance.
And technology, of course. It seems like it's disrupting every industry. How is that a challenge, or maybe even a threat, for a traditional, established broker like AJG?
Technology disruption is definitely a significant and rapidly evolving headwind they have to navigate carefully. The rise of insurtech companies' innovative, often digital-first startups poses a potential threat. These companies, with their new business models, slick user interfaces, and sometimes lower cost structures, could potentially disrupt traditional brokerage value chains, especially in simpler, more commoditized lines of business. They could erode AJG's market share over time if AJG doesn't adapt effectively.
So pressure to keep up.
Exactly. It puts continuous pressure on AJG to innovate themselves. They can't just rest on their laurels. They must continuously invest heavily in their own technology, data analytics capabilities, AI tools, and digital client interfaces. Failure to do so could lead to a significant competitive disadvantage against both nimble insurtechs and their large, also investing traditional peers. And related to all this reliance on technology and handling vast amounts of sensitive data, cybersecurity risks are absolutely paramount. AJG is a prime target for sophisticated cyber attacks from criminal gangs or even state-sponsored actors. The growing sophistication of threats, including AI-driven attacks, only exacerbates this risk. It requires constant vigilance, significant ongoing investment in defenses, and robust incident response planning. Finally, don't forget the talent aspect. As a professional services firm, their primary asset walks out the door every evening. It's their people. The market for skilled, experienced insurance professionals, data scientists, tech experts, it's highly competitive. Talent acquisition and retention are critical ongoing challenges. Retaining key personnel, especially those highly valued producers and relationship managers who join through major acquisitions like Assured Partners, is absolutely crucial for maintaining client relationships and ensuring revenue continuity during integration. We actually saw evidence of this, that the company granted a reported $316 million in special inducement equity awards specifically to former Assured Partners employees to encourage them to stay. That highlights both the substantial cost and the strategic importance of retaining that key talent through the integration process.
Okay, that's a hefty list of challenges. So given all this complexity, the impressive growth, the massive acquisitions, the integration risks, the capital efficiency questions, the competitive landscape, the external headwinds, how does the market actually view AJG stock right now? Is it considered an expensive investment? And what factors are really justifying its current valuation?
Well, looking at traditional valuation multiples, AJG certainly appears to command a premium price tag in the market today. As of, say, August 2025, its trailing 12 months price-to-earnings ratio, the TTM/PE, stood at approximately 45.0x.
55 times earnings. That sounds high.
It is significantly higher than its own 10-year historical average PE, which is closer to 30.8x. So it suggests the market is baking in substantial future growth expectations. Similarly, its TTM enterprise value to EBITDA ratio, EBITDA, another common valuation metric, was hovering around 21.3x to 22.0x. That's also well above its 10-year median, which is around 17.9x. And when we compare it to its closest large-cap peers, Marsh & McLennan, MMC, Aon, AON, and Brown & Brown Bureau, AJG generally trades at a noticeable premium on these metrics as well. For instance, AJG's TTM PE of around 45x is notably higher than MMC's at roughly 25x, AON's around 31x, and BRO's near 28x. A similar premium exists for EBITDA.
Okay, that's a very clear premium valuation relative to history and peers. Yeah. So why is the market willing to pay up so much for AJG right now? What's the bull argument justifying that higher multiple?
There are several key factors that contribute to and arguably support this premium valuation from the market's perspective. First, AJG has consistently demonstrated a superior growth profile. They've reliably delivered that powerful combination of solid organic growth plus their relentless, accretive, M&A-driven expansion, and they've often outperformed their larger peers on this combined growth metric. The market seems to be giving AJG a growth multiple, aggressively valuing its future M&A potential, including the significant anticipated earnings accretion from integrating the monumental Assured Partners deal. It's essentially a forward-looking vote of confidence that this massive investment will continue to translate into outsized growth. Second, there's the track record of consistent execution and predictability. The company boasts that remarkable run 21 consecutive quarters of double-digit adjusted EBITDA growth through Q2 2025. That kind of consistency and predictability in a somewhat cyclical industry definitely commands a premium from investors who value reliability. And finally, there's the nature of its defensive business model. Characterized by that sticky recurring revenue, high client retention rates, and the non-discretionary demand for insurance and risk management services, it makes the business inherently resilient during economic downturns compared to many other sectors. That defensive quality is highly attractive for investors seeking stability, especially in uncertain times. So the market seems to be making a bet that this combination of superior growth, consistent execution, and business model resilience will ultimately overcome the current capital efficiency concerns and drive ROIC above WACC, delivering that long-term value creation.
But with any premium valuation comes risk, right? The higher they fly, the harder they could potentially fall. What are the key valuation risks here? What could potentially cause that premium multiple to compress?
Absolutely. That premium valuation is not guaranteed. It carries inherent risks. It heavily relies on near flawless execution going forward, particularly regarding the assured partners integration. Any significant stumbles there, major culture clashes leading to talent drain, unexpected integration costs, failure to achieve those crucial synergy targets could cause the market to abruptly reevaluate AJG's future growth prospects and their integration capabilities, leading to multiple compression. The decline in capital efficiency, that ROIC potentially being below WACC right now, is another major valuation risk. If AJG can't demonstrate a clear, convincing, and sustained path toward improving the returns on these massive capital investments they've made, the market may eventually lose patience and no longer support such a high premium valuation relative to the actual economic profits being generated. And of course, the elevated financial leverage post-assured partners increases the company's overall risk profile. While manageable now, it makes them more vulnerable. Any negative surprises or a need to raise equity could also pressure the multiple. Lastly, if the recent moderation in organic growth we saw in Q2 2025 persists or worsens significantly, it could challenge that core narrative of superior growth and lead to a derating of the stock, bringing its valuation closer into line with its peers' multiples. The market expects continued strong performance to justify paying that premium price.
Okay, so if we try to pull all these threads together now, the business model, the aggressive growth strategy, the financials, the valuation, the risks, the market context, what are the most significant overarching risks that an investor in AJG needs to keep front and center moving forward?
Yeah, we can consolidate the major risk categories into a few key buckets to keep in mind. First, there are the inherent cyclical and secular business model risks. This includes the unavoidable P&C insurance market cyclicality, with its hard and soft phases creating revenue variability, especially for the brokerage segment. There's broader economic sensitivity. A deep recession could impact client businesses and therefore insurance spending. And longer term, there is always the potential threat of disintermediation from innovative insurtech models that could disrupt traditional value chains, especially in simpler insurance lines. Second, there are significant competitive and operational risks. The M&A integration risk is paramount right now, especially with the unprecedented scale and complexity of integrating assured partners. This isn't just about combining IT systems, it's about merging cultures, retaining key talent, and realizing synergies, all of which are notoriously difficult at this scale. Intense competition for acquisitions could also continue to drive up purchase multiples, making future deals potentially less accretive and putting more pressure on ROIC. And as a professional services firm, talent dependency and key person risk, for example, the eventual succession planning for the long-tenured J. Patrick Gallagher Jr. are always background considerations.
Right. And what about the financial health itself and that ever-present regulatory scrutiny?
On the financial risk side, the high financial leverage post-assured partners is clearly a significant concern. It increases their sensitivity to interest rate hikes and makes them more vulnerable to economic downturns. There's also the potential risk of goodwill and intangible asset impairment. If acquired businesses don't perform as expected, AJG might have to write down the value of that goodwill on their balance sheet, leading to large non-cash charges that hit reported earnings. And of course, there's the ongoing refinancing risk as their substantial debt tranches mature over the coming years. Finally, regulatory and compliance risks are ever present and arguably growing, given their complex global operations. This covers everything from potential changes in broker compensation regulations that could impact their revenue model, to navigating the increasingly stringent and costly data privacy laws like GDPR and CCPA, and managing potential errors and omissions, E&O liability, the risk of being sued by clients for alleged negligence or bad advice. It's a veritable minefield of potential legal and compliance challenges across 130 countries.
Okay, that lays out the risk landscape very clearly. So this brings us to the ultimate question for any potential investor, really. What's the most optimistic, the bull case scenario for AJG going forward? And conversely, what's the most cautious, the bear case that investors really need to consider?
The primary bull case scenario for AJG fundamentally rests on the belief that their M&A strategy remains a proven, repeatable value creation engine, even at this massive scale. In this view, the Assured Partners deal, despite its immense size and integration challenges, is seen as a strategic masterstroke. It elevates AJG into a much stronger number 3 global competitor, giving them enhanced scale, deeper niche expertise, and significant cross-selling opportunities, particularly between P&C and employee benefits. The expectation is that AJG's experienced management team will successfully integrate Assured Partners, realizing significant synergies, both cost savings and revenue growth, and combining that with ongoing operational leverage from the core business to drive continued adjusted EBITDA margin expansion. Bulls also emphasize the durable, resilient nature of their underlying business model, with its high client retention and non-discretionary services, providing stable cash flow, further buffered currently by those favorable hard market conditions and casualty lines. Ultimately, the bull case argues for highly accretive capital deployment. Assured Partners is expected to be double-digit accretive to adjusted EPS fairly quickly, and over time, this accretive growth, combined with deleveraging, should lead to a clear and sustained improvement in ROIC, pushing it convincingly above their WACC. This would unequivocally validate the entire M&A strategy and justify the premium valuation.
Okay, that's the optimistic view. Flawless execution leading to strong returns. What's the counter-argument? What's the core of the cautious or bear case scenario? Where could things potentially go wrong?
The primary bear case scenario fundamentally questions the assumptions underpinning the bull case, particularly around the integration risk and capital efficiency. Bears argue that the Assured Partners integration risk is significantly underestimated by the market. They point to the sheer scale, the potential for culture clash between Gallagher's established ways and Assured Partners' previously decentralized structure, leading to higher than expected key employee attrition, and a realistic possibility of failing to achieve those ambitious synergy targets that are crucial for making the deal financially successful. A major stumble here could severely impair shareholder value, as the market might harshly reevaluate AJG's integration capabilities and future growth prospects. Critics in the bear camp would also argue that the balance sheet is currently overleveraged, leaving the company overly vulnerable to unexpected economic downturns or a sustained period of much higher interest rates. This could potentially lead to credit rating downgrades or strain their financial flexibility. The bear case also heavily emphasizes the weakening capital efficiency, pointing to that ROIC currently running below WACC. They argue this indicates that M&A strategy might actually be destroying economic value in the short to medium term, requiring an unproven, sharp reversal in that trend to justify the capital deployed. They question if the returns will ever truly catch up to the cost. Finally, bears view the current premium valuation as unsustainable and overly contingent on flawless, almost heroic execution. They believe any significant misstep, any failure to meet lofty expectations, could trigger a sharp derating of the stock, bringing its valuation multiple crashing back down closer to its less aggressive, perhaps less exciting industry peers. It's priced for perfection, and perfection is hard to achieve.
Wow, what a journey through Arthur J. Gallagher & Co. It's really quite a story. We've seen a company built solidly on that dual segment model, providing absolutely essential insurance and risk management services. They're clearly riding a global growth wave in their industry and executing an M&A strategy that isn't just part of their growth, it is the engine of their growth, dramatically capped by that truly monumental Assured Partners deal. But as we've explored in detail, this incredible ambition, this relentless pursuit of scale, comes with its own very significant set of challenges, particularly around the notoriously difficult task of large-scale integration, the absolute critical metric of capital efficiency, and just navigating a truly complex and dynamic competitive and regulatory landscape day in and day out.
Absolutely. So if you, the listener, were trying to keep an eye on AJG going forward, trying to filter through all the quarterly noise and headlines, what should you really zero in on? What stands out as the most critical indicators of whether they're succeeding or stumbling? For us, thinking about it, it really boils down to tracking these 5 key metrics consistently. Number 1, organic revenue growth. Can they sustain that healthy mid to high single-digit organic growth, especially proving they can grow the acquired Assured Partners business organically after the integration dust settles? This shows they're winning new clients and keeping existing ones happy, not just buying revenue. Number 2, adjusted EBITDA margin. Is that impressive margin expansion trend continuing, providing clear evidence of synergy realization from acquisitions and ongoing operational discipline? Or was that Q2 spike just an anomaly driven by temporary factors like interest income? Look for sustainable margin improvement. Number 3, return on invested capital. ROIC. This is arguably the most critical long-term metric to watch. Is there a clear, sustained upward trend here? Is it moving decisively toward and crucially above their weighted average cost of capital, WACC? That's the ultimate proof that their M&A strategy is truly creating economic value.
That ROIC versus WACC comparison seems key.
It really is. Number 4, financial leverage. How quickly and consistently are they deleveraging the balance sheet after taking on all that debt for Assured Partners? Watch that debt to EBITDA ratio come down. It shows prudent financial management and rebuilding capacity. And number 5, cash flow conversion. Are they consistently turning those growing earnings, especially the adjusted earnings figures they highlight, into robust, tangible, free cash flow? Strong free cash flow is absolutely essential for paying down debt, maintaining and growing that dividend, and ultimately funding future strategic acquisitions. Follow the cash. And one final point. It's vital to remember the time horizon here. Assessing the success of a strategy this bold takes time. The full benefits, and indeed the full risks, of the massive Assured Partners acquisition, for example, will likely take a considerable 3 to 5 years to fully materialize and be properly evaluated. Short-term performance will absolutely continue to be influenced by the prevailing P&C insurance market cycle, with that current bifurcation between hard casualty and softening property creating a nuanced operating environment. And given their increased leverage and now even greater domestic concentration post-Assured Partners, their sensitivity to U.S. economic growth trends and Federal Reserve interest rate policy has also significantly increased. So those macro factors matter more than ever for AJG right now.
That's great context on what to watch and the time frame. AJG's story is such a fascinating case study in strategic growth through consolidation, that classic buy and build model, but taken to an almost extreme level recently. It really makes you think about how companies achieve and try to sustain massive scale in today's interconnected global economy. So as you, our listener, reflect on our deep dive today, here's maybe something provocative to mull over. How do you personally weigh the immediate, undeniable benefits of achieving massive scale and enhanced market dominance through relentless acquisitions, against the longer-term, often more elusive promise of achieving true capital efficiency and seamless value-adding integration? Is the buy-and-build model, even when executed by a company with a proven track record like Gallagher, truly sustainable for delivering superior shareholder returns indefinitely? Or does it eventually inevitably hit a wall of diminishing returns, operational complexity, and declining returns on capital? It's a fundamental strategic question, and it's one that Arthur J. Gallagher, and certainly its investors, will be actively answering through their actions and results for many years to come.